Headline figures can drive optimism, but the deeper story often lies in the margins. Metro Retail Stores Group, widely known as Metro Gaisano, posted a notable recovery in 2025, with net income rising 12.2% to approximately 683 million pesos, and revenue up by 4.9% to nearly 41.95 billion pesos. At a glance, these numbers suggest progress: a return to positive earnings, growth in same-store sales, and an expanded footprint totaling 81 stores with over 278,000 square meters of selling area. Yet, beneath this surface, Metro's core retail engine faced continuing challenges. Operating expenses surged 9.3%, outpacing sales, and operating income fell 8.2% to roughly 1.05 billion pesos. The business was able to sell more, but it retained less of what it sold. According to the annual report, rising personnel costs, higher depreciation from new sites and renovations, increased utilities, contracted services, wage hikes, and losses from calamities all contributed to this cost pressure. For investors, this signals a retail operation that attracts customers, but struggles to convert growth into stronger profitability. So what drove the improved bottom line, if not core operations? Metro benefited from significant non-recurring gains. Interest and other income jumped 85%, largely from insurance claims related to earthquake damages, and gains on lease modifications and pre-terminations. These boosted pre-tax income and cushioned the impact of weaker operating performance. Finance costs also declined, offering a small but helpful relief. However, these forms of income are one-off and are unlikely to repeat annually. Meanwhile, expansion pressed ahead. Property and equipment rose nearly 10%, inventories grew, and the greater store network required more capital. Short-term loans soared by 250% to 700 million pesos, while non-current loans grew 27%. This capital push increased cash holdings, but operating cash flow declined, highlighting a shift toward debt-financed growth at a time when store-level profitability is under pressure. Metro showed discipline by trimming some leased space, reflected in falling right-of-use assets and lease liabilities. This demonstrates portfolio rationalization, but the associated gains, while real, belong to the realm of optimization, not day-to-day retail strength. The result: Metro's 2025 earnings recovery was genuine on the balance sheet, buoyed by insurance and lease windfalls. However, the underlying retail performance remained modest, with operating profits squeezed and recurring sales momentum lacking. For investors and analysts, the question shifts from headline results to sustainable earnings quality. Can Metro turn expansion into stronger operating leverage and manage costs without relying on non-recurring gains? The annual report offers both reassurance and caution. Metro is stable, expanding, and profitable, but its operating resilience will be the key test in 2026.